12. We just looked at the concept of a collar, isn't it? And we said that what is one of the advantages of a collar is to reduce the cost of using options. So options have got a cost. Options have a cost. To buy an option, you need to pay, and what you pay is called a premium. The question is, how do we estimate the premium? That is, how do we estimate the premium payable? That's what this concept is all about. That's what our discussion is all about. The syllabus expects that you must be able to learn a formula that you can use to estimate the premium. Not only that, you must go a step further and apply the same formula. So what is an option? We have come across this already, isn't it? It's a right, but not an obligation. And this is a right to buy or right to sell a particular good or product at an excise price at or before a specified date in the future. We have a call option, which is a right to buy. We have a put option, which is a right to sell. The excise or strike price is at a price at which a product can be bought or sold. So we've got the excise price, the right at which you can buy or sell. So this is some basic terminology. Let's go for additional terminology. An American option, an option that can be exercised on any day up and until its expiry date, anywhere between today and the expiry date. A European option, an option that can only be exercised on the last day of the option. Premium, the cost of an option. We discussed the last 2 days that you've got the traded option. These are standardized options. Contracts sold on a futures exchange, meaning that they give you a period of time over which you can exercise them. Yesterday we did discuss the over-the-counter option. These are tailor-made options, usually sold by the banks. And these to make it easier to follow. Let's move to the next point. Option value. The price of an option has two components. The price of an option has got two components. What are those components? What are those components? The intrinsic value and the time value. So the option value has got these two components. What is the intrinsic value? The intrinsic value is the value of the option if it was exercised now. If you exercise now, what is the value? That's called the intrinsic value. The best option to learn from is a share option. The best option to learn from is a share option. So we're going to use a share option to demonstrate these variables. Let's use the share option to understand what the intrinsic value is. The intrinsic value looks at the exercise price compared with the price of the underlying asset. We have got a right to buy shares. You have a right to buy shares at $100. If in the markets, these shares are selling for 80, are you going to use your right? You have a right to buy shares at $100 per share. In the market, the share price is 80. Are you going to use your right?
No.
No. What if it's 90? Are you going to use your right?
No.
What if in the market the share prices are 120? Are you going to use your right?
Yes.
So here you're going to use the right because the shares are now selling for 110. You can buy them at 100. You exercise your right, even there. There, you just break even. That leads to the terminology called what? Out of the money, in the money. And when you break even here, you're at the money. The value of the call option will increase as the share prices increase, as you can see there. Conversely, a lower exercise price should also give a higher option value. An option can never have a negative intrinsic value. Please, can never have a negative intrinsic value. If the option is out of the money, then the value is simply what? 0. On the expiry date, the value of an option is equal to intrinsic value. So this is how we calculate the intrinsic value of an option. But where does the time value come from? What of the time value component? So this is what we have discussed here. So what's the time value of an option? The difference between the market price of an option and its intrinsic value is the time value. The difference between the market price of an option and the intrinsic value is called the time value. Buyers of an at the money or out of the money options are simply buying time. Which decreases as an option approaches expiration. Some of you may say, no, Mr. Peter picked nothing there. Just wait a minute. The more time an option has until expiration, the greater the option's chance of ending up in the money and the largest time value. On the expiration day, the time value of an option is 0. And all an option is worth is its intrinsic value. It's either in the money or it isn't. So the time value of the option arises because there's still some time before it is exercised. Now you may say, no, that hasn't gone very well with us. Let's take this example. Let's take this example. In this example, I want to illustrate to you the time value. Here we go. The share price today is 120. The exercise price is 100. But you can exercise this right a year from now. Back to investment appraisal. If this figure is a year from now, if this figure is a year from now, then we must calculate a time value. So we get a time value. We get a time value. We get a time value. So when you convert this into present value, I've used a discount factor of 10%, you get 91. So then the difference between this and that before you discount is intrinsic value. And the difference between this and the present value gives a time value. So the total value then is 29, the intrinsic value and the time value. Do you see where the time value is coming from? It's coming because there's still time before you can exercise. So we must also go a step further and convert this into a present value. And the difference gives us what we call a time value. If that is okay, let's now look at the components of the time value. So the time value of the option has got three components. One, the time to expiry. Is it 1 year, 2 years, 3 years? As the period to expiry increases, the further away the exercise date is, the higher the time value, because there's time before you can exercise. The chance of a profit before the expiry date grows. The other aspect is volatility. How is the variation of the share price? If the volatility is very high, if the fluctuation is very high, then there's a chance that it will become positive. Some of you may say, what do you mean by that? Let's go back here. When we started, what was the situation here? What was the situation here? The value of the option was what? 0. Now the share price started moving, It started moving, It started moving, And because it was moving, what happens? And we had some intrinsic value. But if this share price doesn't move, it moves it doesn't fluctuate a lot. For instance, from 80, it goes to 80.1, 80.2. If the fluctuation is very low, even by the time we reach here, the value will still be 0. But the fluctuation is high because from 80, it jumps to 90, it jumps to 100. So the higher the fluctuation, or the more volatile, the higher the chances that this particular share will be in the money. So what lesson do you pick from here? Shares which are very volatile are likely to be in the money, leading to this assertion here. The holder of a call option does not suffer if the share price falls below the exercise price. There is a limit to the downside. However, the option holder gains if the share price increases above the exercise price. Thus, the greater the volatility, the better, as this increases the probability of a valuable increase in share price. Now remember, I spoke about discounting. Whenever there's time value of the money, what do you need? Whenever you discuss time value of money or present value, what do you need? You need a discount rate. You need a discount rate. And the discount rate that you use here is a risk-free rate. That's what you use. As stated above, the exercise price has to be paid in the future. Therefore, the higher the interest rate, the lower the present value of the exercise price. This reduces the cost of exercising and thus adds value to the current call option. Yes, the discount rate is high, the discount factor will be high. So the present value will be so low. So this is the concept of the intrinsic value and the time value. Determinants of the value of the call option. Summary of the determinants of call option. Increase in share price. Increase in the call value, in the value of the call option. If the exercise price increase, unfortunately, there will be a decrease. But if there is more time to expiry, that increases the time value. Volatility increases the time value. Increase in discount rate increases the time value also. So this is how these variables. So to calculate the value of an option, how many variables do we need? We need 5 variables. The 2 variables are used when calculating what? And these are used when calculating what? And our Black-Scholes option pricing model is modeled on these, the 5 variables. So now time has come for us to introduce you to the formula. The formula is called Black-Scholes option pricing model. What is it used for? What is it used for? The Black-Scholes model values call options before the expiry date and take account of all 5 factors. Use all the 5 factors that determine the value of an option. So the value of the call option, is given by that formula there. What do these items stand for? So predominantly there's the D1 and the D2. So we need to break down the D1 and the D2. So these are the first 2 key variables, D1 and D2. And after D1 and D2, then the rest are here. That stands for the current price of the underlying asset. This stands for the exercise price. That's the risk-free. The time until expiry in years, and the volatility of the share price measured as standard deviation, expressed as a decimal. So these are the variables that we have in here: the PA, the PE, the T, the S. Okay. So once we have these, we can find our D1 and D2. Then from there, we have got ND1 and ND2. ND1 and ND2. What is ND1? ND1 is the area on the normal distribution curve, which is covered by the point up to D1. Now, what we're going to do first, let's get our D1 and D2. Then we can do our ND1 and ND2. Simple question. The current share price, the PA, is 100 of this particular company. That's the current share price. So that's your PA. The exercise price is 95. The risk-free rate is 10% on decimal, 0.1. The standard deviation is 50% on decimal term, 0.5. And the time between now and before that option expires is 3 months. In terms of the year, that's 0.25. So this is how we input them in the formula. Calculate the value of the call option. So what do? We need D1 and D2 first. What do? We need D1 and D2 first. The formulas are here. Your D1 formula is here. And the D1 is here. Please, can you take your calculators for a few minutes and see if you can get your D1 and the D2. For a few minutes, take your calculators. I'll pause this. So that is our D1, our D2. If you use your brackets correctly, you will not have a problem. One area where there's a problem for many students is here. Here. So this is outside. You simplify. So first of all, you multiply this. Actually, start from that one. You come there. That's what you do. Then you add your 0.1. This is an addition here. That's when now you multiply by 0.25. So if you made the mistake, probably that's why you may have made the mistake. Now your formula understands ND1. So how do you get ND1? You go to your normal curve and look at the area covered by D1. So where is our area covered by D1? Let's pick it up. So D1 is here, 0.43. 0.43, what does that mean? So you're looking at the area, 0.43 is positive. This is your 0 here. So because it's positive, it means that your D1 is here. So you're looking at the area from here all the way up to there. What the graph is will give us, we only read this portion. That's what to give us, this one. This portion is 0.5 because the whole curve covers 100% area. So half of the curve is 0.5. So from there to there, whatever we read, we only read this. Then we're all going to add a 0.5 to represent this portion here. The 0.18 also is the same thing, it's after 0. So again, whatever we read on 0.18, we're going to add a 0.5. This is the explanation that we have here. Let's look at the explanation together. If D1, let's go. If our D1 is greater than 0, you add 0.5, this one here. So if it was on this side, to start from here, you add your 0.5. If D1 is less than 0, meaning that you are somewhere here, subtract the relevant number above from 5. Whatever number you have, you remove it from 5. Then it will give you this distance here. Now our numbers are above 0. So let us read them from our graph. Let's read them from the graph together. (0.43). You come here, you pick 0.4. You're looking for a 0.03. So you go. That's your ND1. So the area covered by your ND1 is 0.1664. And because it's above 0, you add 0.5 to this. The other one was 0.18. The other one was 0.18. Let's read 0.18 together. You pick 0.1 here. Then you start looking for 0.8 here. So these meet somewhere there. So again, because our number is above 0.5, you take this figure here. You add 0.5. So you have 0.5714. So that is how we find the ND1 and ND2.
Mr. Peter.
Yes, sir.
On this graph, is there a way where you can find less than 0? I can
less than 0?
See a negative.
So if
yes.
if your answer is a negative, if it was your D was minus 0.43, what you do is you still pick the same figure, but you subtract it. You subtract because you are, look at what you are doing. You are looking for this distance here. The whole of this is 0.5. What this reads, these readings here, they read this portion. So if this is a minus, 0.164 is this one. So it is this portion. But you want this one. That is why they say, how do you find the figure? You take your 0.5, then you subtract 0.1664. You subtract from there to find it, this one here. Have you followed it?
Yes, I've.
Yeah.
So the readings to be the same on this table.
It will still be the same.
That you subtract.
You remove it from 5.
Okay, all right. So that's understood.
Just to reinforce the point Mr. Mfua is making, it's here. Mr. Mfua, let's read it here. If D1 is greater than 0, you're on this side. What do? You add this one. You add 0.5. If D1 is less than 0, meaning that what you have read is here. To find the distance here, what your graph will give you is this one. That's a 0.1664. So just remove this one from what? From 0.5 to find this portion here. Subtract the relevant number from 0.5. Let's conclude for today. Let's conclude for today. So then, the ND1, 0.664. The ND2, 0.5714. So then you have your ND1. You have your ND2, which is this one here. Then you multiply and subtract that, you have 13.7. This is the value of the call option. And this can be split between the intrinsic value. The intrinsic value, remember, the share price was, the exercise price was. So the difference gives you the intrinsic value. So from 1370, if you remove 5, what remains? 870. This is what? The time value. The 13.7 is a full value. Remove the intrinsic value, what remains is the time value. So today we have introduced you to the formula, the black scores. Tomorrow we want to look at the application of the formula. So before our class tomorrow, please make sure that you go through the black scores. You must know how to get your D1 and your ND1. You must know how to get your D2 and the ND2. So if you're able to get that, then you're saying basically you're okay. Are there any questions on the black scores? Option pricing model?
Mr. Piri.
Yes.
So I've seen most of the calculations here done through the calculator.
Yeah.
Not through the spreadsheet.
Yeah.
So how do we incorporate this into the spreadsheet? Do we just put the answers in the spreadsheet?
Yeah. It will be interesting to see. Let me check the last exam if there was BSOP. Yeah. Let's check in the exam because, of course, this is a daunting formula to input this. Yeah. But what the examining team would expect is this expression. Not necessarily to repeat that formula, but to put this expression. Or if you have listed these already, you've got your 100 somewhere, you've got your 95 somewhere, you've got your 0.1, just put a formula to capture this. Okay. So let me counter check if in the last exam there was black scores, but I doubt.
All right.
Yes, please.
That was my worry also. I was about to ask the same question. So from your explanation, can we comfortably do it outside the spreadsheet on the calculator? And then we
Yes,
just put the
in fact, all the other computations you can do them using calculators. That's why they give you a calculator.
Okay.
The only thing is you must show the variables that you have used. Yeah.
All right.
Mm-hmm.
Okay.
Like the way the variables are the PA, the PE, the R, the T, and then you put it there. Then use your calculator. To be faster, use the calculator.
Okay.
Mm.
Yeah, no, because I was about to ask where you get the function for the natural log on the spreadsheet.
On the spreadsheet, eh? Yeah. I will also counter check with the one. I think the other one is easier. We just out counter check the one on the. If it's needed, then it's embedded in there.
Okay.
It must be. It's embedded in there.
Okay. Thank you.
All right. All right, people. This is how far we go today. We've done a lot of work today because we've done a collar, we've done an interest rate swap, we've done black scores option pricing model. So before tomorrow's class, you've got a bit of work to sit down, make sure that these items are in order. The black scores option pricing model is quite an important variable for your exams. Yeah. Because we'll see the application of it tomorrow in investment appraisal. So the question that you have asked really about it's the use of this formula in the exam. It's very important because in investment appraisal, that's why we expect you having to value an option. So we'll check that to ensure that yes, if the natural law can be given or can pop up in your spreadsheet. Right, we'll see you tomorrow, people.
Thank you so much, Mr. Piri.
Yes, thanks.
Thank you.